There's no more than 2 degrees of separation for the people that we do business with, and it's designed very intentionally.
We all have a silent partner, and that's the Internal Revenue Service.
Tax strategy's so good, why aren't you doing it?
What makes a great sponsor today?
Something we did to mitigate our own taxes.
Private credit is getting absolutely hammered right now.
Coastal's a company that is very organic. Everything we do, we eat our own cooking. Everybody on this panel is an investor, whether they're a partner, advisor, or a sponsor. They're people that invest in the products we use, that use the tax products we talk to you guys about. I know a lot of us, as you start making money in life, you know, people come out of the woodworks to be advisors, bring you deals, and start telling you what to put your money into and what tax tools to use. And I'm not the kind of person that does well sitting across from somebody who, when I turn the pen back at them, doesn't have a nickel going into the deal, or isn't using the same tool they just told me all about. And so really Coastal was designed for people that wanted to row in the same boat, and I got rid of a lot of the storytellers in my life that were people that just wanted to give me ideas but not implement them themselves, because we all know the famous saying is, if the deal's so good, well, why aren't you doing it? Or if the tax strategy's so good, why aren't you doing it? And so that's really how Coastal was created. So I'm not going to talk a lot tonight. I know most of you that are Coastal clients, you're probably tired of hearing my voice because it's mostly me on all the recordings or at the events. And so today we've actually got some pretty intelligent gentlemen that are going to do most of the knowledge dropping for us. But I'm going to start with my main man, Carey Sobel. Carey's the one that'll be running the panel tonight. Had to beg him to do that because otherwise that would have been me, so I'm very thankful. And he's pretty good at this stuff if you've ever heard him talk at UCF or any of the big events he hosts. Carey's a 20-year friend of mine. But before I tell you about how professional he looks and how great he is tonight,
there we go,
and his beautiful wife Lauren, when I met him 20 years ago, he went by the alias of DJ Sobes. Those of you that remember. Also had high spiky gelled hair, but I've known these guys a long time. Carey was a very successful entrepreneur, built an advertising company that he later sold, didn't listen to me for a lot of years talking about tax and investing, and then when he finally sold the company and made a bunch of money, he called me and goes, "What the hell is all that tax stuff you've been rambling about? I think I need it." And so he's a great example of somebody that's actually kind of lived what I call like the Coastal dream, sold their business, went through an exit, had a liquidity event, and then had a bunch of money to deploy. Needed what he considered better help than what he was getting at the time. And so he's a great example of someone that's done all those things, and very lucky to have him on our team. He leads our M&A team, transactions that are $5 million, up to $25 million, all the way to $500 million. Nothing's too big for Carey, the team he's got, the investment bankers he's built relationships with. And so it's just one of those pillars that we have at Coastal that I think are very valuable, probably for a lot of people in this room that have either sold a business or might want to sell a business at some point. So thank you, Carey, for being here. Next, we'll talk about the man in the middle, Jason Hendren. Jason's also part of our M&A team. When Jason's not slicking back his perfectly curated hair that he brags to me all the time, looks much better than mine, or driving one of his Aston Martins or Porsches up a mountainside in a big race, he's also helping people sell businesses, and he's done so quite effectively. About a decade ago, Jason had a big exit, sold his lighting company, and then ultimately wrote a book all about private equity, about selling your business, and today, just recently, helped sell a client's $400+ million business, which is always great to see. So him and Carey do a great job on the M&A side for us, helping people get ready, and that's a big division of Coastal we plan to grow over the next 10, 15, 20 years. Next is the man at the end, Richard Hayes. A lot of you already probably know Richard because you've called him with a tax problem over the years. So Rich has been my personal CPA for 15 years, built a big tax firm, sold it to private equity, and then he was crazy enough to actually decide to come work at Coastal full-time and help us do all the stuff that we do. And he really does a phenomenal job and has been not only an advisor but a mentor to me for a long time. So very lucky to have him on our board and with us every day. The guy next to him, Kyle McMinn. Kyle is the CEO of Equipment Zone. Some of you recognize that name because you've used some of his tax products over the years. They're a sister company to another company you guys will recognize, which is Equipment Share. Equipment Share is a company Coastal invested in about 2 years ago that just went public. We invested in it at a $3 billion valuation. They just went public somewhere around 10 to 12. So I know Coastal investors that are in that deal are very happy about it. But Kyle and his team are really the guys that lead the tax program and some of that really innovative equipment tax tool that you've kind of heard about floating around town. So we're very happy to have them here. In fact, kind of a major announcement, Coastal, Equipment Zone, and Madison Capital, who I'll talk about in a second, are launching a new tax company built around big storage containers that will be a tax tool that we will roll out. So a lot of you will hear all about that over the next 6 to 9 months, and we think that's going to be very valuable for a lot of the people in this room. So thanks for coming today, Kyle. The man in blue, Mr. Ryan Hanks. Some of you recognize this gentleman, mainly because you've probably invested in some of the deals that we've done with Madison over the last 6 years. Madison's a company we've deployed over $350 million of capital with. One of my favorite companies I've ever invested in. $10 billion group that sold multifamily, self-storage, build-for-rent communities, and of course now car washes. But Ryan's a dear friend, always has something clever he's working on. And when he's not out, playing golf at his new golf course, High Grove over in Venus, Florida, or at your local hobby shop chasing some Pokemon cards, he's here with us or with Blackstone putting some pretty incredible stuff together. So thank you for coming, Mr. Hanks. And then last but not least, definitely not least, Michael Mann from Anchor Capital. Some of you will recognize some of Michael's work. He's been a seasoned private equity guy for 20 years. Military drone defense deal, Texas injection molding, Equipment Shares IPO. He's the reason we got access to it. It's always kind of funny when two groups that are totally separate are working on the same deal with the same company. Kind of lets me know I think we're doing something right when a bunch of the other big boys are chasing the same stuff we are. So thanks for coming today, Michael. He's going to tell you all about what they do in a new cybersecurity deal he's been holding hostage from me for the last 6 months, which I'm very excited to hear today. But without further ado, I'm going to turn it over to these gentlemen. I think you guys will learn a lot today. Obviously, after the event and during the event, please, if you guys are thirsty or hungry, everything we do is super casual. Get up, have a drink, have a bite. Don't wait till it's over. But thank you guys all so much for coming. It's a great group, and knock the socks off it, fellas. Thank you guys for coming. Cheers. I don't know what I'm supposed to do with this.
We need that, Mike.
There you go.
We also should have probably compared notes because half of the stuff I'm about to say you just said. First, we want to thank you guys for joining us. Welcome to the Coastal Collective. On behalf of Greg, myself, and the entire leadership team, we're really happy that you guys are here. Splitting up the middle of your week in the awkward time between 2 and 6:30 p.m. At a bowling alley. As you can tell, we like to do things a little bit differently here at Coastal. Not the type of conversation we want to have in a stuffy ballroom, so we're glad that you joined us here at Primrose. Thank you to the Primrose staff. You guys have been excellent so far. We really appreciate it. But in all seriousness, we're very grateful for the trust that our investor community places in us here at Coastal. It's not something that we take lightly. And for all of the friends and family and guests that are here that maybe don't know about what we do, we're excited for you guys to listen to us today. And once the conversation is done, like Greg said, we introduce you to hang out, have some conversation, and stimulate some business. The idea behind today was very simple when we put together the Coastal Collective. It was to have thoughtful conversation where opportunity exists. It's to understand the ever-changing landscape and market, and so that individuals in this room, business owners, and investors can best position themselves intelligently for the coming years. Before we dive in, a show of hands, and if you don't mind, when you raise your hand, keep it up for the whole exercise. If you're a current Coastal client or Coastal investor, please raise your hand. Excellent. If you own a business of any kind, please also raise your hand. If you think that you pay too much money in tax, please raise your hand. You all should have raised your hands. But either way, at Coastal, we focus on areas where we believe that we can create value, and it's in the form of providing institutional grade investment opportunities in the form of real estate, venture capital, growth equity. We help out with tax mitigation, and we also do mergers and acquisitions and help out with exit planning. Today you'll hear from some individuals who play in these respective spaces. They are not just advisors, they're operators, they're investors, and they have an incredible amount of knowledge that they're going to share with you today. Coastal was really founded with a simple vision to provide access. Most of you have come in contact with Coastal through a friend. There's no more than 2 degrees of separation for the people that we do business with, and it's designed very intentionally. We're built around disciplined underwriting, strategic partnerships, and long-term alignment. One of the things I've always appreciated about Greg, our CEO, aside from his incredible sense of humor and his PG-13 one-liners and all of his sales pitches, is exactly what he said to you before. He is not going to do business with somebody who is not an accomplished businessman that has an impeccable track record, that has moved mountains before, and that he believes can't move mountains again. He's also not going to invest with somebody who's not invested themselves. It's kind of talk the talk, walk the walk type of deal. This standard is intentional. It's about alignment. It's about credibility. And making sure that the people sitting at our table are those that have the best experience, the best track records, and that's some of the individuals that you're sitting with today. For example, Rich sold a company that he rolled up to private equity. Kyle's business did $1.8 billion in revenue last year. Jason built, scaled, and eventually sold his own business for $100 million. Ryan is responsible for over $10 billion in real estate transactions. And Michael Mann is responsible for over $1 billion in venture capital. These are real numbers, these are real figures, and these are some of our real advisors here at Coastal. So let's dive into the conversation, and you guys can hear what they have to say. First up is Mr. Richard Hayes. Rich is brings a sophisticated understanding of tax strategy, wealth structuring to the Coastal ecosystem. His work focuses on helping founders and investors think proactively about tax mitigation, liquidity events, and long-term wealth preservation. I'm going to ask each of you individually to tell us about what you do and how you serve Coastal, and then I'm going to ask you a couple questions if that's okay. Kick us off.
Well, it's logical that we would start with tax. I think a lot of people look at tax the wrong way, and that is a cost center. Ideally, we want tax to be a capital accelerator. So I spent 30 years in public accounting, dealing with high net worth individuals, helping people optimize their businesses, structure them for sale, mitigate their taxes, and culminating with merging my firm about 8 years ago. I think it puts me in a sort of a unique position to work with Coastal. What I do now every day is I lead our tax team, and we work alongside our investment arm, and we're always looking for an asset, a business, or an investment that might create tax credits, deductions, losses that are useful for our investors. Every dollar we keep off of Uncle Sam's balance sheet and keep on yours is a dollar you can invest, increase your financial security, take care of your family, and so on. I'm also very involved in the due diligence process. So every deal we look at, obviously, we go through quite an extensive and unique due diligence process. I'm very involved in that. And then from time to time, I do raise some capital. I'm an investor myself. Friends, family, and business partners are also investors in Coastal.
Thank you, Rich. I still got some questions for you. You're not done yet. So we share an office wall. We're neighbors. We work together closely, and we always talk about it's not about what you make, it's about what you keep. So what are some investors and sponsors doing to be intentional about tax mitigation?
Well, let me start by saying we all have a silent partner. Every time we have a liquidity event or a large transaction, or even when we're taking profits from our business, we have a silent partner, and that partner does not give you any capital. They're not beside you in the down times, but they're going to be there when it's time for them to get their share, and that's the Internal Revenue Service. So that's why I say taxes we can look at two ways. One of the ways is to look at it as a capital accelerator. So the unique thing about the alt space is it's uniquely, it's sort of ideal for tax mitigation. And why is that? It starts structurally. The structures of these deals are very frequently limited partnerships or LLCs taxed as partnerships. And what does that mean to you as an investor? It means that the tax attributes of the company you're investing in flow through to you. So if they use, for example, bonus depreciation to create a loss or to mitigate taxable income, you benefit from that. Let's compare that to capital markets where you invest in a stock and the stock goes down 6 months later. The only way you're going to be able to absorb that loss and get a tax benefit is to sell the stock. I think another important thing to recognize is when you invest in alts, the holding period is typically going to be long-term and the gain is typically going to be long-term capital. So that's a preferential rate. Ordinary income, I think most everyone realizes ordinary income, you pay a higher tax rate. Capital gains, you pay a lower tax rate. And the last thing I'll say, and I think some other people on our panel would agree with this, the sponsors that we work with, the companies that make these things happen, that build the project or run the company, they are also trying to mitigate their own taxes. So when they create these funds out of the gate, they're thinking about tax mitigation in the short run, tax mitigation in the long run. So I think
Perfect. Great. Let's role play for a second. You and I just met. I'm sitting at the office at Coastal. I'm either considering an investment, maybe I'm asking you about my tax situation. How do you approach my situation individually, and how does that apply from client to client?
Well, I think it's a great idea to use us because
We've done
you're
it.
young and handsome and I'm a grizzled veteran of the financial world. And so our outlook is going to be different, what we've experienced in our financial lives. What kind of businesses have we been involved in? Have we been comfortable with leverage? So I think everybody's story is different, and we like to fact find with our investors. And as I mentioned, it's a value add. It's a thing that you get when you invest with Coastal. And I think when you talk to someone and you get to know them and their financial life and their business life, that discussion usually points you to one or more strategies that might really make sense to them and that they might be most comfortable with, most effective for their situation.
Awesome. Thank you, Rich. And again, ladies and gentlemen, feel free to walk around, grab drinks, grab food. We want this to be casual. We want you to listen to our conversation, but you don't have to just sit here for the full 2 hours if you'd like. I'm going to move on to Kyle next, if you're ready. Kyle McMinn is the owner of Equipment Zone, EZ, a managed heavy equipment rental platform that gives investors access to income-producing equipment assets, and even more importantly for our coastal investors, meaningful tax advantages through accelerated depreciation and cost segregation studies. Kyle, if you would, tell us a little bit about what you do with your business and how you work with us over at Coastal.
Yeah, thanks, Carey.
Yep.
So EZ was started, it really was not developed in the beginning to be a business. This was something we did as investors. And speaking of the three owners, we went in and bought equipment, did a revenue share with the company Equipment Share. So it was not actually in the beginning supposed to be a business. We kind of lucked into the business. What we found very quickly is there was a lot of people out there that were wanting to do the same thing as us, right? So we told friends and family, everybody liked it. I think the first year we did $3 million in sales. This last year we did $1.8 billion. We're looking at probably around 2.2 to 2.3 billion in 2026. Or I'm sorry, 2026. The unique part about our business is, and kind of the reason the name is EZ is because most of you guys have your own businesses, right? I mean, you're out doing your own thing, or you're a high W-2 earner. You're looking for stuff. So what we really tried to take into effect there was, let's make this easy for somebody to have a short-term equipment rental business. When we first started, this really was not, for us, it was something we did to mitigate our own taxes, and from there it grew massively. Is that me?
I don't know who it is.
So from the beginning, when we started EZ, we maintain about a 97% year-over-year retention rate. Because typically, as most of you guys know, if you take advantage of something that is a tax strategy or becomes a tax strategy for you, you're going to do it again. So when we're talking about big numbers like 1.8 billion, we're already looking internally that we're at that sale number already again this year, and then we add extra equipment into that. So like you guys, we're very organic. We've never advertised this business. In fact, we've never spent a dime in advertising other than doing some events for our customers. It's all been word of mouth, which is a testament, I think, of what we're doing, because if somebody does something and they like it, typically they tell their friends, right?
Absolutely.
So everything that we've done has been from word of mouth and people coming to us. Later on in the business, Coastal became, let's say, a referral partner of ours, and so we typically work through referral partners. Our staff is 14 people, so to have 1.8 billion in sales with 14 people is pretty incredible.
It's incredible. And honestly, the best businesses come from when you solve a problem yourself first, and then you can solve other people's problems. So
That's exactly right.
So you've had an incredible success growing to 1.8 billion, and obviously you said the future outlook is good. What is the future outlook for the company? What are some new things that you're planning to do, and just talk to us about what 26 looks like?
Yeah, so we're always evolving. We're always evolving in the business. One of the things that we're doing is taking our special sauce, and for those of you guys don't know, what we do now is we buy equipment, but it goes into a co-op revenue. So what we're doing there is mitigating the risk. So if you own one piece of equipment and you have rent coming in there, you would be tied to just that one piece. So if it's down on repairs or maintenance or something like that, then you could be out revenue during that time. But by co-oping that revenue, we're able to flatline the revenue, and everybody is going to get the same percentage every single month. So that was kind of the secret sauce we put on to this business, but we're adding that into some other assets that'll be coming this year. And I'll tease that a little bit. Some of it is in the NVIDIA server business. We're placing them in co-op data centers, and then there's revenue generated by that. Each person can buy a unit from us. We buy them in bulk. We turn around and sell smaller units. So we're just kind of taking our secret sauce of what we do as a company and adding it into other assets. Greg alluded to the container business. There's going to be similarities there, which is why we're happy to be part of this collective here.
Yes. I purchased equipment from you, and I'm very thankful for it.
Thank you.
How much money do you think that you've actually saved for investors since its inception? And that's kind of a crazy question to answer, but just put some color to it.
Yeah, so I mean, I know just in the year of 26, it was over 400 million of tax savings. Over the life of Easy, it's up in the $2 to $3 billion worth of tax savings.
Incredible. Do you briefly want to touch on the recent IPO of Equipment Share and talk about maybe how that is going to impact EZ, because there is a symbiotic relationship there?
Yeah, so Equipment Share IPO'd, I think it was January 23rd. We were early on investors. When we met the CEO of Equipment Share, they had one location. So we've been with these guys since the beginning, really have watched them grow. We bought into their business, and for those of you that don't know, Equipment Share focuses on the tech side of the business. Construction tends to be a little bit more blue collar, and a lot of times they don't embrace tech like a lot of the other industries work or implement into their businesses. So what they've done is able to add tech into multiple different levels. They developed along with us what they call their own program. And the reason they did that is to be very light on the debt on the assets, right? So when investors are coming in, they're securing the debt, they get full access to the equipment, so they're very light on debt on their balance sheet. So we knew that they were going public for quite a while now. We were excited about that because like the Coastal Group, we were able to get in pre-IPO and watch these guys grow. What it means for us is the reason they IPO'd is for expansion. Nobody's trying to make a payday right now, right? So what they're looking at doing over the next 5 years, they're at 323 locations currently. They plan to grow to 600 locations in the next 4 to 5 years. So you're looking at an average of about 80, 88 locations per year. Along with that, it takes $30 to $50 million worth of equipment per location. This is equipment they don't have, they've got to procure it, so they're leaning on us to make sure that we can continue to do what we're doing, make sure that we can bring in investors that want to buy into the equipment that keeps it light on their balance sheet.
So in other words, it's going to help.
Yeah, a lot of people originally they're like, is this going to help or hurt? And we're like, hey guys, it's going to help. So we went with a projection, internal projection this next year of looking at somewhere around 1.8 billion again this year. I just had a meeting with them and we're looking at about 2.2 of equipment. They do cap us. We're 40% of their overall fleet at this point, which creates a lot of power in the industry. So they do keep us at bay, let's say, because I could sell enough for their entire fleet. So we'll probably run that same 40% ratio as they continue to go.
Incredible. Congrats on all the success.
Thank you.
Thanks for being here as well. All right. Next up is Jason Hendren, CEO of Hendren Business Advisors and a nationally recognized exit planner, advisor, author, and entrepreneur. He founded and scaled a business that he led through multiple private equity exits while overseeing the M&A activity. Today, he advises business owners on equity sales and strategic transactions ranging from $4 to $400 million. His expertise bridges business growth, exit readiness, and strategic capital planning. Jason, thanks for being here today.
Thanks for the kind introduction, and thank you, Greg, for having me.
Yes. Tell us a little bit about what you do on the day-to-day basis and the relationship with Coastal.
Yeah, so of the folks up here, I'm the newest to the Coastal family. I had started a manufacturing business back in 2002. I did my first exit in 2012, and I became a partner and CEO of a private equity-backed business that we continued to scale. We did our second exit in 17, and then I left the business in 20. But during that entire time, I ran the M&A for the company as well as being the CEO. So it kind of gave me the insights as a buyer and seller of businesses, just kind of how professionals do that. So when I left the business right before COVID, I was 48 and kind of looking to retire and go travel, but obviously that wasn't in the cards. So it all kind of started with a friend of mine who had a company that he wanted to sell. He had reached out and said, hey, you understand how all this goes. Can you kind of guide me through this? And I said, you know, this is kind of what I wanted to do as I kind of continued through my retirement, because I had somebody who did this all for me, helped me kind of navigate this more as like a Sherpa or a board member than like a broker or an investment banker. So from then until now, I've basically kind of professionalized the business, and I help entrepreneurs navigate exits. And that kind of goes through a broad range of what that means through the different stages of the process. You and I have been friends for years, and even predating Coastal, we were talking about collaborating because we both love the M&A space, we love working with business owners. So we had been talking for years about how we could possibly work together. And then as you became part of the Coastal team, I got to know Greg, became an investor, and Greg was like, hey, you know, Carey, you're leading this M&A stuff, you know, let's partner with Jason, because the partnership makes a lot of sense. Yeah. For what I do, my clients need tax mitigation strategies. I wish I knew Kyle when I did my exit in 2017. I really wish I knew Kyle in 2017. But with my clients now, I have these alternative to give them as part of our 4 pillars of planning. And that's been great for me for what I can do for my clients, and for the folks who are in the Coastal community and are just like, hey, how do I do this? It gives you another arrow in your quiver so we can work on those deals together and help those clients navigate.
And for anybody who does own a business out there, I encourage you to check out his book. It's incredible insight, and it takes some really complicated topics and makes them very rudimentary to understand. It's a really solid book. Jason, you're getting ready to work with an entrepreneur. He or she may be a few years out from sale. He or she probably doesn't know if he's a few years out from sale. How do you approach an individual situation when you're working with an entrepreneur?
Yeah, every entrepreneur is different. So I have one client right now, 2 partners in their 60s, and we're having conversations about what an exit may look like for them. And financially, that's very different than another partner I have or another client I have who's in his 40s, wants to take some chips off the table, diversify his personal balance sheet. So the first thing I need to do is get to know that individual. How are they thinking about spending? Are they closer to retirement? Do they have kids that they need to put through college, or are the grandkids thinking about college? How do they think about philanthropy? How do they think about flying private? I try to have to get an idea of what it means for them to take their money producing asset and create something that's going to be a non-active investment. And is it enough money? Model what that means for an exit. Try to get a feel for what their multiples look like, what their balance sheet looks like, what a transaction could provide for them, and say, hey, this is a great opportunity. Do you have any idea how much this is worth? Which that's a great conversation to have. And sometimes it's like, hey, you can't afford to sell this business. You need the cash flow for the next 10 years. So it's really just getting to know the personal scenario that each business owner is in, and just really evaluate what they're looking at and if that's right for them at that point in their life.
And we've kind of merged a little bit of our practice together, because primarily you are more on the advisory side than an actual transaction broker. But we're seeing, as we kind of work together, it's all about what's in the best interest of the client. Some people should be teed up with an investment banker and you get out of the way. Some need hand-holding the whole way through where you eventually sell. So I think it's really been a nice organic relationship so far. I'm looking forward to it. Question to you that I could probably talk about for a while: how early should business owners start the exit planning process before they actually want to sell?
Yeah, in a perfect world, I want 2 years. And the reason for that is, if you kind of unwind that from the transaction, if you're going to do a transaction, it's going to take 60 days, 90 days to get through customary due diligence. If you go through the process of hiring an investment banker, there's at least 2 months of marketing the deal, getting the deal ready to be marketed, going out and doing all that. And then I want another year in front of that. So my thought process is always, I want to go out, develop relationship with investment bankers who understand the industry intimately. I want them to tell you what the value triggers of the industry are. I want to know what people are paying for, what people are discounting, what things you could do to help the business. And one client that I had, we identified some things that he was in construction and service had a higher multiple. So we accelerated some of his plans to get into service, and we think that that paid dividends when he went to go sell the business. On a business that has a $10 million EBITDA, a half a turn on the enterprise value is a lot of money. So we want to try to identify those things, have time to put them in. I also want time to figure out if the CEO just wants to go home after the transaction. I'd like enough time for them to hire a business leader that can fill in for them so that they have somebody to backstop them, which makes the argument better to reinvest less and have a shorter horizon after closing.
Yeah. And we could talk about that topic for a long time. If anybody is interested in further discussing your business, we do have a business owner summit on March 27th. Come up to me afterwards and I can get you some information and an invite to the event. Jason and I will be hosting it. Thank you, Jason. Next up is Mr. Ryan Hanks, the founder and CEO of Madison Capital Group and a trusted strategic partner within the coastal ecosystem. He brings more than 20 years of commercial real estate experience and oversees investment and operating strategy across a diversified portfolio of alternative real estate assets and platforms. His platform plays a key role in sourcing and structuring high-quality opportunities for coastal, which we bring to our investors. Cut yours off. Yeah. Good? All right. Ryan, if you wouldn't mind telling us a little bit about the many things that you do and maybe how the relationship evolved with Coastal over time.
Yeah, so founder and CEO of Madison Capital Group. Our headquarters are in Charlotte, North Carolina. So we do a number of different things. We've got really about 4 or 5 verticals within the Madison group of companies. We do a lot of multifamily residential development, Southeast-based merchant developer. We have a construction company, Benco Construction. We have Go Store It, which is a top 10 owner-operator of storage properties throughout the country. Then we kind of have Madison Commercial, which does your net lease, build-to-suit, acquisition, development strategy. We started doing that as, again, part of a tax strategy where I was looking for tax incentives. When the government decided to kind of change their thought process around like conservation easements, which I was a big user of, I immediately started looking for other avenues. We had other family offices that we were working with and started doing things, again, on our own for my own purpose to save taxes. And that's actually how I met Greg Meerbaum and Richard Hayes. You know, we got to know those guys through a tax deal that I was doing regardless, and Greg participated. So it's been fun to kind of see really him from an investor to where Coastal is now. But we do that through our commercial division, and then we formed some other verticals like Link's Car Wash, which you guys have been very active in, and we've got about 45 car wash locations throughout the country, and then we have a large convenience store operator and fuel company that's throughout the Southeast as well. So those kind of make up the different verticals within Madison.
Awesome. I'm not sure if you guys can kind of see the theme here, but people are solving problems for themselves and kind of pushing it together to create success. And there's nothing more fun than either making money with friends or saving money with friends. Usually you're friends first and then you make the money, but sometimes it works the opposite way. But Ryan has a ton of different platforms, and I want to know, which one are you particularly excited about the most right now?
I can't answer that question.
What's the second one?
You know, listen, they all have different advantages in different, you know, different parts of time. You know, we were talking about that earlier. Obviously, I'm very excited about, I think, the convenience store and car wash business. You know, I like building companies, and so we own other companies outside of Madison, but it's just fun to build management teams, an OpCo and a PropCo play, which those kind of give you that ability to do. You know, in the real estate development world, it's kind of hard to do something like that because you're only as good as your last deal.
Yeah.
Your kind of fee streams are choppy, your revenues are choppy. But yeah, I'm very bullish on those because I think there's a lot of, you know, room for an institutional player there. And again, I always say it's my first love. I started in the multifamily business when I was 21, was about to become a father, was a, you know, wannabe baseball player for a minute. And so, you know, that's the first job I've ever had, you know, real job I've ever had. And so we've had a lot of success around the multifamily space. It seems to always kind of be the first to kind of get kicked in the teeth. It's oversupplied, it's got issues, and I've seen it come roaring back over 4 or 5 times in my career. So I'm very bullish about where that space is right now. You know, we've never had a demand issue there. We've got great financing available with Fannie Mae and Freddie Mac and life companies that we don't have in other asset classes we deal with. But yeah, I'm really excited about where the demand is there. I think, you know, good or bad, we have more and more people renting, young and old, whether that's, you know, townhomes or, you know, single family housing or apartment communities. We'd like to touch all 3 of those asset classes. So I have a good feeling 2026, 27 is going to be a pretty robust year for not just our portfolio, but others as well.
It's great to hear, and we're going to touch on that in a little bit in a panel-wide discussion. But as Ryan mentioned, Go Store It. How many locations do you have now?
So we have 250. We've done probably close to 350, but we've sold a lot along the way. But currently today we have 250 locations.
It's an incredible portfolio, 3rd largest in the country.
Almost, I'd like your number better. Yeah, that's no. I think we're 9, depending on who you ask. But I like 3rd. That's pretty good. Well, bronze. You know? So
let's talk about then Go Store It. You know, kind of you know, roll up strategy. But let's talk about Link's Car Wash. Right. This is something that was birthed 2.5 years ago now.
Yeah, I give Mr. Meerbaum, I guess, the credit. You know, the Porsche guy, we call him. I think at that time he had an Aston Martin, maybe a few cars. But yeah, it was something that we had looked at for a while. So we were developing for other car wash operators through our commercial division.
Is that right?
Just like convenience stores. So we were a preferred developer for one of the country's largest operators, and, you know, just started studying the business. And I didn't want to go into it kind of half-assed. I wanted to make sure we had a management team that we could plug in. We were fortunate to find, but, you know, Greg and I were talking about that for probably a year before we really put pen to paper on, you know, getting that off the ground.
And fast forward to now, there's 40?
I think we're about 45 locations. We've got a handful. Hopefully we'll break ground on 5 new projects this year, maybe more. And then, you know, we'd probably buy another 20 to 30 this year, depending on, you know, capital raise and whatnot. But, you know, hopefully we exceed that kind of 60 mark by the end of the year.
And Ryan touched on something. He said he doesn't like to do anything half-assed. A critical component to Ryan's success is vertical integration. Now, any of you guys that are coastal investors probably know about this already, but can you talk about how that positively impacts everything that you do?
Yeah, I don't know. Yeah, it's it's there's a reason I have a lot of gray hair because of it. So, being a control freak like Greg, I didn't want to get information secondhand, thirdhand. So that's why we built out, everything we do. We own the trademark, we own the name. We self-perform on construction, we self-manage everything. So a lot of it was just really control, not even, profitability. Some of the management companies we probably lose money on, but I think from a capital raising standpoint, there's a lot of value there. And for me, it's the
knowledge.
Access of information. Yeah. There's a lot of value. So a lot of people talk about it. And I think that's the biggest takeaway when you just think about Madison in general is vertical integration on everything we do. We outsource some things here and there, but from the top down in terms of management, revenue management, call centers, so many different things that play into all these different companies. But we spent a lot of time and energy trying to become what we are today.
Thank you, Ryan.
Thanks.
And lastly, Michael Mann, who contributes deep operational insight and strategic perspective to Coastal's investment approach. His experience evaluating growth stage businesses and navigating complex market environments strengthens our ability to identify scalable, high conviction opportunities. Michael, thank you for traveling and joining us today.
Of course.
Tell us a little bit about Anchor Capital, yourself, and your relationship with Coastal, if you would.
Yeah, we're a growth equity fund. We'll talk more about what growth equity means, but we focus on businesses at an inflection point where capital and strategic value are exactly what the company needs. They have clear-cut, on-ramps to growth, to exit down the road, and we invest in pretty much everything. I always say it's easier for me to tell you what we don't invest in. We don't invest in real estate, oil and gas, and biotech, anything with an FDA risk. But everything else we're open to looking at.
Awesome. When people hear venture capital, risk is usually the first word that comes to mind. How do you assess risk today, and how has that changed from the last cycle?
All right. I've been thinking about this question for a little bit. Venture capital today is the most general term you could use when looking at private businesses. You could ask one person that's a little more old school, and they'd say, well, that company's doing $1 billion in revenue, losing money. There's no way it's worth $5 billion. You could ask somebody and says, well, this is the greatest napkin idea. This is a guarantee win. I'm going to make 10,000x, and that's venture capital. So venture capital today is I always say the series letter, the stage, it all is different amongst what you're looking at. What I would say is that, and I'm going to use an analogy with Equipment Zone. He said when he had one piece of equipment, if he attached that to you, the risk of it going down and being, you being in trouble is really great. But when you put 1,000 pieces of equipment together, it moves, organically. And that's the way I consider venture capital today is that, and I tell people all the time, for somebody to be very successful in pure venture capital, early stage venture capital, you have to have a ton of companies. Because what I've learned over my career, the one that you think actually is going to win, it usually doesn't. The one that you don't think is going to win, but you're taking a flyer on it, that's the one that usually does. So that's definitely where I consider venture capital today, and I think that's where people make the most mistakes is that they put all their eggs in one basket, and and sometimes it's great, sometimes it's not.
So why is growth capital not the same as venture capital?
Yeah, because we're investing in companies that are probably I'll use the equipment share since a lot of people here know that he was fortunate enough to see this way before everybody else did, and went in. We looked at it when they were doing, hundreds of millions of dollars in revenue. They had a clear-cut thesis on how they were going to grow, and we looked at the market opportunity, their strategy, and the exit strategy down the road, and said, if we add capital and we see things through, we would have a good return. We're IRR investors, as I tell people. We're not MOIC investors. So I'm not trying to find the next 50x return. We're trying to find consistent businesses that we could see a clear-cut growth, and whether that's in an M&A transaction or an IPO, that's really where we want to see an exit. On top of it, a lot of times today, especially in the world we're living in today, there are so many great ideas. We could talk about AI for, the next, to oblivion. And everyone looks at an idea and says, well, that's gonna next $1 billion idea, right? 99% of the time it's not, because the actual TAM, the market for that product, is limited to a very small subset of either companies or people. So when we look at a company to invest in, we want to understand that there's a market that the company continue to grow into. It's not just going to be limited to what that, a smaller subset of people or companies or products.
So I'm interested personally how you choose the companies that you invest in. And before I asked that question, we were talking before this, and you said you were part of 5 IPOs. Is that right?
Yeah, yes.
I'd love to share with the audience what those are about, how you landed on those companies before. Talk a little bit about that experience.
Yeah, I'd love to say they were all my great ideas, but I have a lot of amazing people around me. I think that when you're, we can get into IPOs, but what I would say is, when I looked at a company like UiPath, which went public, it's got to been now 3-4 years from now already. But when I looked at that business, they were doing automation. And when we look at AI today, it's like even way more down the line than automation was back then. But we looked at what they could actually be able to build and how many companies actually needed this. And that was a big part of why we invested. And their CEO, Daniel Dimes, is a rock star. I think that a lot of times in life you have to invest in people, especially on some of these amazing ideas that are still growing. Because, even if you butt heads with a CEO or you don't sometimes like what they're doing, if you believe that they're doing the right thing for the future or they're doing in the best interest of the investors and the company, that's a big part of the way we invest. I've never invested in a founder that I didn't believe in. I'm not always right, but I've always said that it starts with that.
Awesome. Last question I have for you is deal specific, the Texas injection molding business. So as someone who plays in the M&A space, I love boring blue collar businesses. I think there's a couple brokers and M&A guys in here as well that would probably attest to that as well. How did you land on that deal, and what's your outlook for it?
Yeah, let me go back even before that deal.
Sure.
So, the way we land on deals, and when we were talking about product market fit, like one of our biggest exits in our company's history was an app called Jackpocket. I don't know if anybody, I don't know if it's available in Florida at this point, but it's an app where you could buy a lottery ticket on your phone and it actually gets printed on your phone. And it sounds like such a ridiculous, crazy idea and how that would happen. But when we sold the company to DraftKings for $1 billion, I think we were doing about $700 or $800 million in actual lottery sales, just because people didn't want to get off their couch; they wanted to put it on their phone. So when we look at these companies, we're looking for I think in the world, I think everybody, raise your hand if somebody's approached you about investing in SpaceX, right? Like it's going to be a lot of people. Finding great deals sometimes is because it doesn't, the old saying, like, why did it come to you sort of thing. So a lot of times these are companies that, when you see deals, they're not perfect. I always say, like, the perfect deal doesn't exist, right? If you find a deal and it's a slam dunk, chances are, it's same in real estate, right? Like if it's the best deal, it most likely won't happen. So we're looking for companies that there's something that why it attracts us. Now, on Texas injection molding, for a group like ours that invests in a lot of technology and different things that are, drone defense and things like that, we looked at this business and we said one thing. There's a lot of things in this country that have changed over the last couple of years, and one of those things is sustainability. I think if everybody talks about it and looked in the mirror and said to themselves, if we went back 4 or 5 years ago, sustainability, you got rid of plastics, Plastic Act to get rid of it. And what happened was private equity funds ran away from companies that had anything to do with plastic because they knew that these multiples were going down. Well, we're now in a world that there's a lot more other issues that people want to, scream and pout about. And, sustainability, from what we've done is not one of them anymore to some degree. So when you look at it, like a company like Texas Injection Molding, they're the premier injection molding business in Texas. If you don't know what injection molding is, if you have a plastic water bottle in front of you, it was resin at some point, it's heated, it's molded, and it becomes plastic. Same like, the bowling, lane right here, that plastic cover. And what happened was we realized that the multiples in this business have been compressed so incredibly over the last decade. We went back and looked at other transactions that have happened, and we realized that the multiples are a third of what they were. And we directly correlated it to that. So we look at, that, and most injection molding businesses are founders that have been doing this for a long period of time, so they're probably looking to sell. And there's a really interesting maybe roll-up strategy at some point, but we don't see, the need for an injection molding business going out anytime soon.
Thank you. The next part of the program is a panel discussion, so we invite all of you to participate if you feel compelled to do so. I have a couple topics I'm going to throw out there, so whoever wants to chime in, please do so. First theme is market landscape and capital discipline. Starting high level, we've experienced volatility over the past few years with interest rates, capital markets tightening, and changing buyer behavior. As operators and investors, how would you describe the current economic environment, and what do you predict for the remainder of 2026?
Start? Oh, I'll start. I have an opinion on the market today. I think that we're in a period of time just like 1999 with the internet boom. We are seeing something with AI today that is very different. People don't know what it's going to do. People don't know what it's going to mean. We all know, we'll admit it's going to change the world. We hear all these things that robots are going to take over us. So I also think that with that, when there's hype, there's, people run and pay any price. And we're definitely seeing that today, that valuations are ridiculous in pretty much anything you do. We haven't seen a downturn in the market in a long time. We haven't seen, COVID was a short-lived downturn. And we believe that there's just going to be, as capital becomes, is still semi-cheap, there's still an opportunity to invest. But investing is a long-term thing. If you're looking at your account every day, you're going to drive yourself nuts. And that's why people invest in not just publics, but real estate and other things. But for the overall, I believe the market's doing pretty good. I think there's a lot of overvalued stuff. But if you really track, the last 5 years, if you take the magnificent 20 stocks out of it, the public markets are flat. Those, most of the other companies haven't grown at the same rate they have. So.
Obviously, our business is a little probably different than everyone here because we're in the real estate business. Interest rates obviously directly impact cap rates, most of this time. So, yeah, it's definitely been challenging. There's no question. I reminded our staff, and we had kind of an institutional investor day in Charlotte not long ago, and had to kind of remind myself and everyone in the room. It's like we went through a pandemic that no one had ever seen before. Then, euphoric high, followed by, 2022 is when rates started to rise. And it's been, a challenging time to kind of run your business in that kind of environment. And so I think where we sit today is, I think you're back to some level of normalcy, which is all we can ask for right now. We're seeing, I think there is a belief, certainly with the new Fed chair, probably interest rates normalize, continue to decrease throughout the year. Job numbers probably are worse than people think, or weakening, which isn't a bad thing for rates. And so, yeah, we've just been kind of playing a waiting game, knowing that what we've done is good stuff in good locations and good markets. As he mentioned, it's not, if you did this to yeah, we have quick hits every now and then, like probably everyone does up here. A company booms, a stock booms, there's a piece of dirt that booms. Those are great, but the reality is a little bit of a steady Eddie business. And over the long term, we've made a lot of money. Again, in the apartment space is a great example. If you were holding on for 5 to 7 years, you probably did really well. So yeah, it's been challenging, but we think we've got probably more tailwinds than headwinds going forward. And so we're pretty excited about the future. And as a company, we're actually kind of in hiring mode right now. There's a lot of talent available for companies that are going the other way. And so we're picking up talent where we can and get ready for kind of a next run.
And I think it's a testament to kind of when you started your business, right? It's 2009, is that right?
Yeah, January 1 of 2009.
So opportunistic, looking at when you can create some value. And I had another note on here that while you have the microphone in your hand, if you don't mind, I know your answer, but let's talk about capital patience versus capital urgency. This is a market that rewards patience or decisive action. I think you already kind of answered that, but if you don't mind.
Yeah, there's no question. I mean, we're unique in that, I don't know what the exact number is, but I would say half of our equity comes from, accredited high net worth investors, like those that kind of go through a coastal fund, a registered securitized offering, et cetera. And then we have institutional capital. The biggest of the biggest, the Prudentials, the Carlyles, KKR, TPG, to name a few. And so, yeah, they're more driven by, events that don't affect us. Obviously, the office market's been challenging, and so they've had to liquidate good assets to cover losses there. So it's a much better game to be where we are with the coastal side than I think with institutions. There's pluses and minuses with both, but during this time, this is kind of where you want to be. It sucks for a minute, but it certainly gets better if you've got the patience to hold on. There's no question, patience will be rewarded, I think, in 26, 27.
You can always sell an asset, but we're stewards of our investors' money, and we want to sell an asset when we can get the most juice out of it. So patience is something that's hard in the investment game, but when you're stepping into the alternative space, it's critical. So I appreciate that answer there. Does anybody have anything else to touch on that particularly?
We talked about this. This question reminded me of working with my father in the yard, and we would be doing a little renovation to the house, and when he sent me to cut a piece of lumber, he would say, "Did you measure twice so you can cut once?" I think patience is so important at the beginning of a deal when you get to know who you're working with. And to me, one of the critical things is if you get to the point where you're ready to give someone a lot of money, you believe in their project, but can they adapt when and if something goes wrong? And I think this goes back to things that Michael was saying. The project that you think is a layup is never a layup. Something changes in the marketplace and there has to be an adjustment. If you work with the right people, they can adjust. And I think you achieve that in part by being patient, going in, knowing who you're working with, and feeling comfortable that they can make those adjustments if they're needed.
So in this environment of volatility, who is forced to sell, and why does that matter?
People that don't have liquidity, and that's the most important part. And in how you started your business, he took advantage of illiquidity in the market and times when you can get things cheap. I think that's one of the biggest mistakes that our society makes today in this world, is that when times are great, everyone always over leverages themselves or buys too much or does things they don't. So, I always say that, if you ever look at Warren Buffett's history, when times are great, he has the most cash because he makes the most money when there's downturns. So,
Strong balance sheet does wonders. This one should be fun. From an investor perspective, what are you completely avoiding right now?
This is going to be the most contradicting thing I'm going to ever say, and everyone's going to hold this against me. I'm avoiding AI right now. I think that there's, and when I say we're contradicting, we do invest in AI. I think that there's a lot of hype around things that are happening. I think that there's a lot of unknowns. And when I said before the 1999, right, Amazon made it and Oracle made it and all these other great companies made it, but there's a really interesting stat, and you can look it up. Cisco Systems, which is one of the most important companies in the country today, if you would have invested at the height in 1999, $100, you would have had to wait till 2025 to get your $100 back. And it's not because it wasn't a great company, it was just because the valuation was out of control. So when you're looking at things, just because it says X, Y, and Z doesn't mean for a $100 billion valuation or something that, is a must-have. I always say I'd rather have a lot of room to run than a guarantee. And I don't know if there's any guarantees anymore.
All right. We'll go on to the next theme. Before I do that, Nick, Chad, you guys over there, can you hear me okay? Audio's good? Thank you for the sound check. We're going to talk about alternative investments and portfolio construction, obviously incredibly relevant to today and everybody that's in this room. We are seeing alternative investments represent a larger share of high net worth individuals' portfolios. It's becoming a mainstream name. I personally get a little frustrated when you see the big box shops that are now offering alts, because realistically they're still retail to some degree. Everything we do at Coastal is private. They're private markets and it's very intentional. But this shift of alternatives becoming more mainstream, why does it matter and how should investors think about the role of alternatives alongside of traditional stocks or bonds?
I'll something that I don't even think Greg knows this about me, so Greg might be shocked. I'm one of the largest historical document collectors in the world, so I'm only one of the only people that have a day one constitution in private hands. And historically, when I actually started buying this stuff, I thought it was just a collectible and it was something that was set on my wall. Over the last couple of years, I met a woman in New York that just raised a $50 million fund to buy Birkin bags. And she showed that if you bought a Birkin bag and you held it for 20 years, you outperformed the S&P 500. And I said that was bad news for the women in my life, but as an argument to me, but it was true. So what I'm getting at is, I think that alternative investments is becoming a very different, it's a very different look than what we just talk about with private companies or real estate. It's becoming a much bigger, allocation of things. Where I see the private markets continuing to grow and alternatives is that we live in a society today with, you look at your phone, you look at everything, and people get stressed. And the whole thing about consistent investing, why real estate investors are so successful, is because they can't look at their portfolio every day and say, well, it's down 10%. And you stay to the long-term approach. I think it's now becoming on the alternative side about access. As you said, retail access is going to be retail access, and there's not a lot of great deals out there. But I actually think it's going to be where the best returns are going to be, or where the differentiated ideas of something as crazy as buying a handbag.
I'm not a financial planner by trade, but I would just say generally, if you've got the right team, alternative investments are part of a well-diversified portfolio. I think they perform differently than public market investments, so they create different kinds of liquidity. They can increase your liquidity because of the tax benefits.
Thank you. Shifting a little bit, what makes a great sponsor today beyond returns? That's probably a good question for Ryan.
I think for me, it's not just the vertical integration, which I think is more important now than ever. But I think the big thing is just like Greg mentioned, everyone's at Coastal's mentioned, you kind of, you eat your own cooking, so to speak. So I think, when I started out at Madison, it wasn't, well, I want to create this much fee revenue. I personally wanted to make a lot of money. I know it sounds a little, I don't know, cheesy, but I had that Gordon Gekko mentality. I didn't want to use other people's money to make money. I wanted to make money. And that's still what we kind of do today. So when I look at something, when I take a Ligsit as an example, like I want to put more money in it. So I think finding people, and I'm sure their fund's no different, it's finding founders and partners that, they either had a strong conviction in what they were doing and kind of seeded the portfolio or the startup, whatever it may be. But I think to me, it's kind of eating your own cooking. Is that how you made your money? Is that your goal? Or is it more, well, we're going to just create a fee stream that then we can monetize, which is okay too.
Yeah.
But I think it's kind of a good balance of both. But I think starting with that first point is probably good.
And for us, Coastal, we're looking for communication, transparency, including in downside scenarios, right? We're partners, so it's good to know the good, it's good to know the bad, and I think all of our partners have done an incredible job keeping us up to speed with everything going on so we can in turn convey that information to our clients. Is there any asset class that might feel misunderstood right now?
The one that I keep coming up against is private credit. I think private credit is getting absolutely hammered right now, and from a lot of the stuff that's been out there, the valuations on some of the private credit stuff is way down, and I'm actually looking much more closely at some private credit stocks that are throwing off a high single-digit dividend right now, and the risk portfolio within those companies isn't as high as some of the prognosticators out there have made it seem.
We were just talking about that before this. All right, so how does tax strategy, because we're talking about portfolio construction here, how does tax strategy influence that?
I guess I'm required to start this one. I'm going to go back to the statement of capital accelerator. And let's talk about integrating alts into your portfolio. So if you create $100,000 a year of cash flow on, we were just talking about private credit, that interest is ordinary income. It's taxed at the highest tax rate. There's no way to mitigate that other than external tax planning. So if you collect $100,000 a year on that investment, you're gonna be able to reinvest about $63,000 of that money, right? You're gonna pay Uncle Sam their cut, and then you can invest the rest of that income. If you put it in an alt, and it happens to be structured as return of capital, so when you receive payments, it's treated under the tax code as a return of capital. This is frequently permissible, and it's used by sponsors in the space. I'm not gonna say it works every time, but when they can do it, they do. That distribution, that 100K, is not taxed in real time. So you've got 100K to deploy and reinvest instead of 63K. And that attribute remains in place usually until the underlying asset is sold. So this is a significant difference between a lot of the public investments and an alternative investment, and utilizing that tax advantage to increase your balance sheet.
Thank you. We have one more theme, and we'll run through it pretty quickly, but it's preparing for liquidity and strategic capital planning. So many people in this room own a business, some will in the future, and not even just related to business ownership. Everybody has liquidity events for a number of different reasons. Let's talk about preparing for that before it actually happens. We already covered that one, but what creates enterprise value beyond EBITDA? And for everybody, it's essentially your profit, what you're actually making from the business, earnings before interest, taxes, depreciation, and amortization. Most businesses are valued on EBITDA, so I'm asking you guys, what makes a business valuable besides the EBITDA number?
So I could speak to, more operating companies than, real estate assets. But when we're selling operating companies, the first thing is, what's the tail of the industry? So, when I think about the value of Blockbuster Video at one point in time, obviously the industry transitions were going to devalue that company. So the first thing is, we want to think about the industry as a driver of value to that company. The second thing we want to think about is how is that managed? What's that?
Hold it a little closer, and then just turn the volume down a little bit.
Yeah, so the second thing is the management team, and what type of asset are you selling? Is the company well-rounded? Does it have a good management team? How's the transition going to be? Is the leadership in the prime of their career? And as you kind of pull those things together, that's what drives multiples up and down. So it's the EBITDA times a multiple, and if you're growing, multiple high. If you're shrinking, multiple close to zero. If you have a great management team, multiple high. If you have a management team that are all a year or two from retirement, that's going to affect the multiple, because all of those things are going to introduce risk into a deal, and risk is what drives down multiples.
One thing to also think about for non-EBITDA but positive businesses, because what we're starting to see in the market is something very interesting happen, is that, so we're going through, we actually closed on a company, one of our portfolio companies today, which was doing about $30 million of revenue, losing $50 million a year, and we made a huge, huge profit. The reason is that a lot of companies are worried more about time. Time meaning, if you notice in the public markets, when earnings come out, a company can go down 20% because they miss by 2%. The reason is that people don't have the patience anymore to deal with that. When you're a leader of a company and you are building the business, you might look and say, well, that business maybe financially isn't the best, but their technology or whatever they're doing is so needed in our cog of what we're doing, their customers or whatever it is, that we actually need to, that for us to build that, it's not the money, it would take us 2 years. And as CEO, I might not have 2 years. So to answer your question on the non-EBITDA positive businesses, like Wiz was a cybersecurity company that just got acquired by Google by $30 billion. They were doing $190 million, losing about $400 million at acquisition. So the world is changing in that aspect, that people don't have the patience anymore. And I think that's something that's going to come back to earth at some point.
How do tax decisions today impact valuation later? I got a good illustration on this one.
Can you repeat the question?
How do tax decisions today impact valuation later? I mean, this is one that we see all the time. I always say that you can win once. You can win every single year when you reduce your taxable income. Or you can win at the end when you cash out for a higher multiple. Think about this illustration. For every dollar that you write off, if you're in the highest tax bracket, you may save 37 cents. For every dollar that's on the bottom line of your EBITDA number, and you may go get a 4, 5, 6x multiple, that 37 cents you saved might have been worth $5 or $6. But every single year, we do the same thing. We try to save as much as we can on tax. Not saying it's not what you should do, but that's a pretty good illustration on how tax can impact valuation. That's the broker's perspective on it. Let's hear the tax advisor's perspective on it.
That's a great point, and I think that's an argument for some external tax planning so that you don't erode the value of your business.
Yeah.
I would also add that I think if you look at tax structure, and this kind of boring stuff, but how is the business owned? What is the legal structure? That can be a significant piece of the pie. And as we always say, it's not what you make, it's what you keep. So if your structure is good, we can hopefully help you keep more.
Yeah. And just taking write-offs and whatnot is not actual tax planning. It's using sophisticated tools like Kyle's company. It's using tools like Ryan, what he pushes through his company. Everything that we do here is either tax deferred or tax advantage. We do what we can to try to keep money in your guys' lives. I think at this point, it seems like the crowd's getting a little rowdy over there and everyone's having some cocktails. So I'm going to go ahead and thank you all for, some of these gentlemen flew in from around the country to be here today with us. Really appreciate you guys taking the time out of your day, sharing the knowledge with us. And we hope that you guys understand that we don't take these relationships lightly. It's because of people up here on the stage today that we're able to do what we do at Coastal. So thank you guys for joining us. And thank you all. Oh, yep. And lastly, thank you all for being a part of the Coastal community. Like Greg said, we try to keep it a little casual. This event's in a bowling alley. We're talking in front of the lanes. We want you guys to enjoy the rest of your time here. We're going to turn the lanes on. Everybody have some drinks. If you have questions for any of the panelists, they're going to stick around for a little bit. If you want to learn more about anything about Coastal Investment Company, come up to one of the Coastal staff members. We'll be happy to talk with you. But on behalf of the Coastal team, thank you all for joining us today. We appreciate it.